On Wednesday, Fed Chair Jerome Powell spoke at the Brookings Institute where he outlined the future path of monetary policy given inflation right now. As a result of some of the ideas that he gave the market about where the Fed was headed, we saw a rally across asset classes. This rally included gold, silver, Bitcoin, stocks, and bonds as yields fell. Now, this path that he outlined was fairly straightforward. Basically, that rates are probably going to have to get higher than where they initially expected, but the rate at which they are increasing those rates might slow down as early as December, and they'll just have to wait and see what happens with inflation to determine when to end their tightening. But we can read between the lines just a little bit more to get more of an idea of where they're headed. Because as we know, as the economy gets over-financialized, everything just becomes one trade. It's either inversely or positively correlated to the dollar, whatever monetary policy decides. If they make more money, more abundant money, that means prices in general go up. And if they take money away, that means prices go down. So we're going to look at three things that Powell said. The first one is that he said policy must get to a point where it is restrictive enough to have an impact on inflation. This means he expects rates to reach somewhat higher levels than officials estimated in September. At that point, the median projection was to top out at 4.6%. And in a couple of weeks, at the FOMC's next meeting in December, these will be updated. But at this point, investors expect that number will be somewhere around 5%. Now, you might think this is just an absolute no-brainer. Of course, if you're trying to fight inflation and the tools that you have are selling assets and raising rates, then obviously you're going to have to use those tools and make the monetary policy restrictive enough to be able to bring down inflation. I mean, that's literally what you're trying to do here. But it's important that he says this because it highlights the fact that they're still trying to achieve some sort of a soft landing. They don't think that it's absolutely necessary that them tightening will cause a recession, even though you and I both know recession is already here, at least for the first half of this year. And he actually came right out and said it, that a so-called soft landing remains very plausible. Because if the only thing they cared about at this moment was to bring down inflation and that's it, all they would do is jack rates up to, let's say, 10%, and that would have a pretty immediate impact. But they're still trying to thread that needle, and they think they can do it without tipping over into a recession or a deflationary death spiral. And that's why he said that we think slowing down at this point is a good way to balance the risks, meaning that sometime as soon as maybe even in December, they might not be raising rates at 75 basis points at a time anymore. Starting as soon as December, they may only be raising rates at 0.5% a time and might even slow down after that to even 0.25% again. Real quick word from today's sponsor, iTrustCapital. iTrustCapital allows you to use your retirement account to invest in Bitcoin, gold, and silver. Many people, when they buy gold or silver or Bitcoin for the first time, they just go out and they make the purchase, whether it's from a gold dealer or buying Bitcoin from an exchange. Later on, whether it's a year or 2 years down the road when the price has gone up a lot, they go to sell it and realize they're hit with a capital gains tax. This leaves people with a sour taste in their mouth when investing in gold and silver and Bitcoin because they're saying, hey, look, I know that inflation is eating away at my fiat currency, my dollars, but if I put my money in sound money, if I buy gold, if I buy silver, if I buy Bitcoin, I'm going to get hit with a tax on it anyway. And that's why it's so important to take advantage of retirement accounts when you are diversifying your assets. The problem is most brokerages, most retirement accounts do not allow you to invest in gold or silver or Bitcoin or any other cryptocurrencies. That is where iTrustCapital comes in. You can buy and sell Bitcoin, gold, silver inside of your IRA anytime. You can use this retirement account to make new contributions, or you can even use old retirement account money rolled over into an IRA with iTrustCapital. With everything going on right now in the crypto industry, many people are concerned about any exchange, any place that allows you to buy cryptocurrencies, about security and fraud. With iTrustCapital, they never take custody of your assets. There is no mingling of assets, and there is no way for iTrustCapital to access clients' money. It is securely stored in third-party institutional storage that is cold storage. And it's a regulated trust company so that it is a legal IRA. Like I said, they take security very seriously, which is why I use and recommend iTrustCapital to invest in gold, silver, and Bitcoin for your retirement account. And if you use my link in the description below, there's a special bonus waiting for you as well. Now, the second thing that I think is very important that Powell noted in this speech on Wednesday is that he said we recognize there's a lag time between which monetary policy happens and when that realizes itself in the real economy. This is something that I've been talking about for about 2 years now on this channel, that there is a lag time. And this isn't anything new. This is something that Powell acknowledged as early as I think 2017 or 2018 when they were raising rates last time. And he said, basically, look, there's a lag time, and that is absolutely true. This is called the Cantillon effect. When you increase or decrease the money supply, first it's going to hit asset prices, and it takes about a year for those effects to be felt on the real economy, and you to see those results impact the prices of goods and services. And so when we take a look at the change, the year-over-year percent change in the money supply, we have a complete collapse in the growth of the money supply. It's now at its weakest since May of 1995. This also shows up in other measurements of the money supply other than M2. If we look at the total money supply, this is a money supply measure made by Rothbard and Salerno. We can see that this also shows a complete collapse in the growth of money. You can see it on this chart as well of M2, which instead of showing the change year over year, this is just a straight up number of how many dollars there are that they're measuring in the system. Right now, about 21.3 trillion. And if we zoom in on the chart here, we can see that all the way back in November of last year, 2021, the money supply was also 21.3 trillion. So for a year now, the money supply has moved sideways. It moved up a little bit going into 2022 and then has trended down since then. So on net, for a year now, the money supply growth has been absolutely non-existent. This means that other leading indicators of inflation, like for instance, the cost to ship a 40-foot shipping container from Shanghai to LA, has plunged to its lowest since May of 2022. And so while it does take a while for monetary policy to hit the real economy, it's been tightening for a while now. So we are already at the point here where we are starting to see some of the results of the initial tightening hit the economy. And that was another thing Powell was getting at here, is he's saying, hey, look, we'll probably want to start pulling back on our tightening here because the real economy is going to start feeling the effects of our tightening that we started almost a year ago now. They'll start to feel it very soon here. And I agree. I agree with the fact that we're about to start to see the results of the last year of tightening. I don't agree with the fact that maybe that means it's time to get easier. And I actually think that's how the Fed is going to respond incorrectly to that. But that's a discussion for another video. On to the third thing here that is absolutely important to take away from what Powell said about the future path of monetary policy is that you don't need positive real rates in order to bring down inflation. Again, this is something that so many people disagree with me on because they think, how could you ever have inflation come down if inflation is 10%, but rates are at 5%? Well, that means that rates are still negative on a real basis. So that is an easy monetary policy that provides support for inflation and continuing the money supply to grow. How could you ever get in front of inflation if your real rates are negative? And the answer is it has to do with the debt load. So let's walk through this from a personal budget standpoint to see very clearly how this works. Let's say you make 100 grand a year. After taxes, you take home 50 grand. You spend all 50 grand that you make every single year. You've got a mortgage, you've got a car payment, you've got some credit card bills that have piled up, you've got your groceries, your utilities, and every single month, your entire paycheck gets spent. And you are loaded up to the hilt with as much debt as you can possibly afford. Some of that debt is fixed rate debt for 30 years, like your mortgage. But some of that debt is adjustable rate debt. You've got credit card debt. You've got, let's say, a loan on a car that's about to break and you're about to have to go turn that over, buy a new car, get a new loan. So your debt load is maxed out. You have an income level right now that is just enough to service the cost of that amount of debt. If you move forward a few months and interest rates go up. That debt service cost now becomes unmanageable for you. Instead of your payment on your debt being $1,000 a month, it goes up to $1,200 a month, $1,500 a month. You don't have any extra room from your income to devote more money to your debt service cost. That means you have one of two choices. You're either going to default, or you're going to have to cut back consumption from somewhere in order to pay off some of that debt so that you can continue surviving. Now, here's where I normally run into some more disagreement that people say, yes, obviously that's how it works with an individual, but there's a big difference between an individual and the overall economy. It just works different. And the answer is there's actually no such thing as the economy. There are just a bunch of individuals that make up a network that we call the economy, but it's not a separate entity. It's just a bunch of individuals making their own decisions with their own responsibilities. So when we talk about the amount of household debt, the amount of corporate debt, the amount of government debt, these are all just aggregated of individuals. There's no entity outside of individuals. So how does this relate to interest rates bringing down inflation? The overall economy right now, is more over leveraged than it's ever been by many measures. This means that we have more debt than we've had in history by many measures. That means that whether you're a corporation or an individual or government, rates going up is bad for you. You can barely afford to service the cost of your current debt load. When interest rates go up, that debt gets more expensive, and when interest rates get too high, that debt gets too expensive. That has nothing to do with the inflation rate. When the debt load becomes too expensive, deleveraging happens either through defaults or through reduced consumption. When that happens, money gets sucked out of the system for the deleveraging to take place because it cannot continue to survive with the current level of leverage, and that in and of itself is deflationary. So even if real rates are still negative, when you factor in inflation, it does not matter. If the debt load has gotten sufficiently large enough to become cost prohibitive for interest rates to go up and to continue to roll over that debt service cost must be reduced through deleveraging. And deleveraging is deflationary and will offset the inflationary pressures. Has nothing to do with whether those rates are negative or positive in real terms. Has everything to do with the size of the debt load. And if one thing is certain, our debt load is big. So in summary, Powell outlined the future path of monetary policy here given what is happening to inflation and the leading indicators of inflation. He's saying that as soon as December, they might start lowering the amount that they raise rates by, but at least sometime soon, they're going to have to start pulling back. So they won't be raising by 75 basis points every single meeting into the foreseeable future. They're going to go down to 50, go down to 25, and they'll top out a little bit more than what they originally anticipated, but they are going to be topping out soon here, and they think they can thread the needle, stop inflation while at the same time not tipping over into a deflationary death spiral, and I am not as optimistic about that. As always, really appreciate you guys. Thank you so much for watching. Have a great day.